You have to see hold levels and break levels are slightly different in one way, as to where a hold level will be attacked over and over and over and over to see if there's enough interest to long the move up, right? So it will be constantly attacked to see if it can move the move up, as to where a break level becomes a target. So when you're looking to trade, like a break level will become a target. And let's what we can do for this to kind of illustrate this is like this. Copy, paste, good. That's done, that's done. So to give you an idea, like this would be okay, fine. You don't want to work. This is a target, right? So you can see in the moment here, it became a target. This first test is like a target. This would have also been a target here, right? Which actually is an attack of this. So if you look at this here, it's much the same as this here. So where someone would misappropriately mark the valley here and say, oh, well, that actually moves straight through it. Well, no, actually you missed the original valley here, which is a target. So this is kind of what break levels are. They are targets in moves. Right? Even you go to some of these other valleys here, you see how this becomes a target. It is first touch rejection because it's a target, because people want to re-inject. That whole idea of actually, let's talk about that for a second. Good question. That whole idea of first touch or whatever is actually quite flawed, but you have to explain it to people like that because it's a very easy concept to grasp and put in your hand before you get into a larger onset of knowledge. It's actually very quite good. So when something is, and let me just mark this as a hold level. The idea of something being rejected 90% of the time is not because it's first touch. It's because the hold level has to concur afterwards, because people will take this short on this position all the time. They will always take this short. It doesn't, you could test this 100 times. And if there's enough percentage from here to here, people will take it, because max leverage on 4% on contracts, or any like leverage position on contracts, anything. When you see something that gets constantly hit over and over and over and over, this becomes a testament of shorts being taken, right? This doesn't, like, that's something you have to blow out of your mind. First touch rejection all the time. There's a deeper layer to that. You don't first touch reject 90% of the time. Rather, what you do is you take profits and look for re-entry positions. So in this situation, we are not creating so this is another debilitating factor that has to be debunked right now, which I'm glad we're talking about it. Instead of looking at this as first touch rejection, move up, this is the same hard capping of a concept that will debilitate your ability to see the moves even deeper. You cannot have these, oh, it's going to first touch, I must sell, because you will get, there's a reason why first touch only works 90x% of the time, or 85 or 95 or whatever it works, because it doesn't always work, because it's not an exact. It's not the fact that it's first touch rejecting. It's the fact that it has to create ladders, and there are hold levels that have to concur in succession. You cannot create, if you were to be able to create ladders off of first touch move up every single time, it would simply be, the chart would look like this would go up. It would go straight up because this is the maximum profit opportunity. This is the maximum sell opportunity. It would come straight down. People would rebuy here, and then it would just go like that. And they would be these volatile, like extreme swings in charts. Rather, you have the idea of exhaustion isn't an index ratio where you can say a coin is exhausting over this trend 8 times, and after the 7th time it's exhausted at a rate of X, and the 2nd time it's compounded at a rate of X. Yes, that is a very surface way to look at it, and a great way to hold it in your hand and say, here is the beginning to understanding a deeper concept, right? The deeper concept is that it has to ladder up off these moves to the point where the short profit targets become the next range, right? So if you have a valley from here in the past, for example, if this was a valley in the past, which it most likely is, if this is a valley from the past, you need to ladder up against this valley the same you have to against this valley, because if there's 4% here, that means there's 3% here, and 2.5% here, and 2% here, and 1% here. But in this 1%, there is 4% here. So it's just the reoccurrence of a cycle based on laddering. People don't want to take shorts against 1% profits. They want to take shorts where the shorts make sense. So in a case where you see first touch rejection, This is because something has dropped down to such a level like this, right? That you will have that swing of that 4% here or 4% here, right? Like, what is this swing right here? Well, there's your 6%. So of course people are going to short that. This is like, well, okay, let's short this because they're not going to hold all the way up to here because there's more money to be made if you take this trade here. Free roll the hold level to see if the hold level can get hit, which is right here. You hold this hold level to go and attack the next valley, which is right here. And then when that one gets hit and held, then you can hold this hold level here and go attack this valley back here. So you have 6%, 4%, 6% instead of maybe hitting 9%. You've doubled your profits and taken zero risk instead of, because really if you trade properly, you can have close to zero risk trading as long as you can spend enough time in front of the charts, because there's a very conceptual rule of nature that happens here, and you can see it, right? You can see there's a very specific thing that happens where you can always kind of guarantee free roll entry based on these valley breaks. If you were to enter here, you have two scenarios that can happen. You have two possible outcomes. You have outcome number one is going to be in yellow. So we will mark this as yellow. No, wrong one. Outcome number two, we will mark in green, which is your inverse level. One of these has to equal true. Now, number two, which is going to be green, can be true across many timeframes. Number two can be true on this level here, which it does execute to be true here, right? Number two can also be true right here, which it indeed does execute to be true. But then you have another moment where you would have had a fractal valley in there. So two is continuously being true. So this is a matter of finding the correct number two. So if this green is number two and you are trying to find the correct, number two will always be correct in one time sense. So if you are to always buy where you're supposed to, which will be a hold level from the past, one of these dotted lines, and then sell number two or number one in the current, you will therefore have then always bought the correct level and sold the correct level. This is execution, right? So this is the difference of execution. In this case and sense, this is always going to be 100% of the time a profitable trade as long as you can see one and two and identify number one and number two properly. Also, while on this side, identifying this number two or this number one down here, right? So this has a two and a one down here on this side. This will always be true, which means that if you can always have a true trade, it means that you can always sell this valley and buy back lower. And every time you see a one, where this is a one, this is a one, this is a one, you can always, every single time, 99.9% of the time, unless you miss it, you can actually do it 100% of the time. You can always buy a hold level and sell its appropriate level of rejection or completion. And even on a level of completion, so in this case, as to where the move up was like this being the number one, in this moment of completion, you will always have a chance to buy lower in this moment. And when this gets hit, it's not about first touch rejection. It's conceptually, it has to see if it can hold the level that brought it there, which is this, right? So this is the hold level. And if it can hold this, then you can rebuy this hold level just like we bought this level down here by identifying this properly. We have therefore identified this properly. And if this event has to happen or this event has to happen, which one must be true, otherwise the charts don't exist, that means that there's always an opportunity to rebuy as well, just like there was right here. Every time you have one of these hold and break levels, you will always see the ability to re-enter the trade. It's about identifying one and two, and you will always have the ability, if you're good enough, you can always sell the correct level and you can always buy back down lower. This is the reason why first touch doesn't really exist, because it's not about first touch. Rejection means you can move up in the future. That's the static way. That's the thing we put in your hand, or that's the thing that I put in your hand to give you something to hold on to while you're figuring this larger piece out, right? That's the thing I put in your hand to say, okay, first touch, this is a rule. Now we need to break that rule so that you understand the deeper conceptual levels of what's happening. There will always be a point where you can re-enter the trade at a lower time frame, which, yes, first touch does reject 90% of the time, but it's not rejecting because it's first touch. It's rejecting because there's a better capital injection point where you can take profits now, free roll the move, take profits now, and see if the level concurrent to that time and space will hold, allowing you to move up, retaking the next position while reducing risk and increasing profits all at the same time. So first touch is like a conceptual nightmare. Like this rule of first touch from this day forth, like blow it out of your mind. It doesn't exist. It shouldn't. Well, it should so that you can understand why this is happening. But once you hit this point in trading, now just get rid of it completely because it is now about not understanding. I have a point here, which is going to be first touch. I should sell. No, you should identify that as, okay, if it touches here, it's going to break the move. That means I need to see the reaction that it is going to have after that move breaks. So I need to see it hit this move to confirm an uptrend so that we can see that it's going to break in the future. Once that level gets touched, we're not first touch rejecting. We are confirming the attack of a higher level and now looking to hold the level that's going to allow us to attack the level that's higher than that. So you're not first touch rejecting. You are setting the move up in the future to move forward. It's how you see bigger moves happen, like Bitcoin Cash ABC when it moved up, or like BTT, or like, you know, some of these things that we talk about in Discord. You're not first touch rejecting. You are setting up a break in the future and trying to confirm the hold of that move up. You see, there's a large difference there. One is conceptual, one is execution. The conceptual is first touch rejection. This is fine to hold, to create a rule and to start to understand the larger piece. The execution is understanding this is setting up a larger move. We need to now hold the move going forward. And if we can hold this move, we have then confirmed a ladder, which is also giving us an uptrend. Now, if we can hold that uptrend, we can get into this famous pinching point that we so desperately need in all charts that we love to see, right? But that's why that pinching point exists, where we have this pattern like this, right? The science will tell you how it gets there, and it will show you exactly where to buy, exactly where to sell. It's like, how much time can you commit to the charts? How much can you actually put in to see these moves happening? Right there. You can see it right there, that little wick. Oh, it must have been a bear trap. You know, like that famous, oh, man, we got caught in the bear trap. It's so crap. It's like, no, you're testing the move to see if it can hold the move up, right? It's a hold level. You just didn't see it fractally because you didn't understand the significance of it, and you didn't see the relevance of the move, and so forth and so forth. It's the valley that's holding the move to attempt to hold it up. You see, it's not a bear trap. It's confirming an uptrend. This is the execution layer, not the conceptual layer. This is the execution layer of exactly what you just talked about. You say you get stopped out on these moves, and this is where people should be re-injecting, because this is where this is why I've had a very tough time having to answer people say, like, where's your stop? Because if I tell them where my stop is, then they're going to start to ask 1,000 questions. Oh, I'm stopping here. Well, what the heck? You're stopping 10% lower? Or I would say something like, okay, I'm stopping, like in a traditional sense, you want to stop out on the leg because it's going to break. Well, in a technical sense, if the hold level breaks right here, I'm actually going to lose the move. So I don't want to stop out on leg, because you can actually see failure before that. You can see the failure happening on the break level, because in a technical sense, if a hold level can't hold, it is breaking something else down on a fractal, that's going in the books. It's breaking something on a fractal level, which could be that, or it could be this. The hold level not holding will lead to the breakdown of the trend, and the breakdown of the trend will lead to the back attack of the leg, which is also going to have fractal relevance, right? A level like this. So in this moment here, and then you would go into a 15-minute chart and see where we drew these. You can see the uptrend being held, and you will probably see the leg of the move, which would be right here, the relevant trend to that. You can see failure before it, right? Like you can see this failure before, because even then you would have this right here. You would have this right here, which will show you failure. Once this moves up into this, you'll see that point of failure by using your trends against the larger holds and breaks. And then you would see the move being held. maybe on a 5-minute, because now we're getting pretty tight in time. Like this is where you have to make these decisions in the moment. Yeah, so you'd have this right here being the level that needs to hold against, like this is the hold level against the break, which is right here. So your exit on this in a actual sense should be when you see this comes down, tries to retest the leg up on a more on a fractally higher level, gets stopped out at the hold level, and then falls down against this trend here that's creating, well, okay, this trend here that has created its second leg of distribution, which will be right here now. So when this hold level gets hit, like that should be exit. So you can't say, like, you go to the larger time frame now, like this hourly, and you look at this picture, and you can't now all of a sudden say, like, okay, well, I'm going to, you can't say, like, I'm going to stop out on the hold level, because there's actually something where I'm saying I'm stopping out on the hold level. It's the hold level that's coming back up to attack the valley that brought that distribution leg down. So I'm stopping out on the inverse hold level in the future. I'm not stopping out on, like this. You have two sides to this move. You have the up and the down. People traditionally will stop out on this side of the move. That's incorrect. You stop out on this side of the move, because this right here will show you if the move is failing or not, as to where this, you're just basically stopping out on points of reinjection where other people are going to reinject fractally. Because in this side, you have, okay, I'm buying here because I expect the move to go up, therefore means I want to stop out here, therefore equaling a trailing stop, which is flawed. Because and this is why, because you can see failure here when you have this comes up, comes way back down, creates this wait, let me redraw that. Comes up, comes down, creates this little thing like this, right? Comes down like this. You'll see failure here in the valley. You'll see the whole level being hit because the valley can't be attacked. This valley that it's trying to create, if it can't attack this and it's holding the move down based on the micro valley in here, then the move is downtrending. You are now technically laddering down on a fractal time sense, creating these trends right here. So stopping out on this side can never be correct. So this is, like, it's really hard to answer people, like, where do you stop out and why? Well, you have to stop out here when you see failure up here for those reasons, not back here where people are re-injecting because the smart people got out at the top, like that difference between how do you see the top versus the bottom. And then the bottom becomes a testament of, okay, are we stopping, are we re-injecting this level to move up fractally, larger time frame to back attack this, which already happened in here, and to ladder up even further against this, right, against this wedge. You see what I mean? So where you're stopping out here could possibly be a re-injection point against this leg here, as to where if this doesn't hold, you're most likely breaking this, targeting that hold level down here, going like this, and then bouncing up way past that up here. So you've stopped out here, or you've stopped out here, and then, or no, you would stop out in this region right here on this hold level, when actually you should have stopped out here to rebuy here. It's like the maximum trade, the maximum option trade. Like it's the way to trade. Like the science can show you this whole thing. You can draw the science 100% of the time. This is like a formula that you can just recreate over and over and over and over. It's just, how good of a scientist are you? How good of a scientist are you to actually see the formula every single time, right? Because there's deeper parts to this formula. It's not so simple.
Hey everyone, how's it going? As you know, I'm now giving out some of this content for free that I was otherwise charging for the past little while. Yeah, drop a donation, subscribe to the channel, join Patreon. You'll get access to Discord. Great way. Lots of top level traders in there, people who are doing this for a career every single day. So go to Patreon, join a tier, get access to Discord. Go on Reddit, talk about future of trading, talk about the science of trading, talk about cotton candy, socials, everything you can. Let's help this thing grow. It's the way you guys can thank me for giving out this content for free that I was otherwise charging money for. So I'll leave a Bitcoin address on the screen. I'll leave the Patreon address on the screen. Just do something to help out. Okay, thanks guys. Take care.